S&P Global have performed analysis that shows REITs outperform other major asset classes over the longer term. We can see REITs up 10.8% annually on a total return basis over a 25-year period versus stocks and bonds. Now we're looking at 2 REITs to buy now, 2 REITs to sell. We're going to take a look at each of these REITs. We're going to look at the historical performance. We'll take a look at their dividend safety, look at some of their financial metrics, and as always, we'll run them through our intrinsic value calculation to get to our acceptable buy price given our investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. So our first REIT to buy now is ADC Agree Realty Corporation. It is down, however, 23% over the last year, largely due to the interest rate hikes. Over the last 10 years, however, it is up 87.57%, although do bear in mind it doesn't include those dividends reinvested, and has a few times over the last few years hit its all-time highs just under $80. It currently trades towards the mid to lower end of the 52-week range with a yield of 5.2% and a forward P to FFO of 14. Dividend safety sits at 70, it's safe. Market cap $6 billion, a mid-cap company. And when we take a look at those recessionary metrics, well, they cut the dividend during the last recession. They had average growth of negative 14%, but they did trail the S&P negative 67% versus the S&P's negative 55%. When we compare this with their dividend growth, well, they increased it 1.6% in October last year. Pretty poor in my opinion. We want to see a minimum of 4% to keep up in line with inflation. Over the last 5 years, however, 7%. Over the last 20 years, 2%. So a mixed bag there over the longer term. And we can see they have increased those dividends for the last 10 years. In terms of dividend yield theory, now for those that are new to the channel, it states a company is undervalued when the current yield sits above the 5-year average. 5.2 versus 3.82. We have our first sign of undervaluation. Do bear in mind though, we don't look at any of these models in isolation, and we will conclude towards the end. Forward P to FFO, another sign of undervaluation, 13.9 versus the 5-year average of 19.3. Now comparing it to the sector P to FO of real estate, 13.7, it isn't too far off Agree Realty's. So typically on the channel we focus on the free cash flow payout. However, for REITs we take a look at the adjusted FFO, the funds from operation. We see a blanket rule 90% for the large majority of REITs. Nice to note for ADC, it is pretty consistently around the mid-70s. 2024 expected to be around 72%. In terms of the adjusted funds from operation, well, nice to note that consistency nearly doubled over the last 10 years, moving in the right direction, and 2024 expected to continue that trend up to $4.10. Percentage-wise as well, we can see pretty consistently around that 3 to 10% mark year on year, 2023 at 3%, 2024 at 4%. Now for REITs, we want to see steady moderate growth, 5 to 10% on the top line year on year. Absolutely smashed it with their top line, pretty much in the mid-20s every single year over the last 10 years, 2023 coming in at 25%. Numerically then, for those that love to see numbers, $54 billion in 2014, $537 million in 2013. So one thing I do say in terms of shares outstanding with REITs, that it is very, very typical for them to dilute your position over the longer term. We can see it in fact go from 15 million to 95.4 million. One thing I would say that ADC, they do dilute your position at a very rapid rate in comparison to other REITs. And the reason they do this is that they have to issue equity to fund property acquisitions, as they do retain a little of that internally generated cash flow after paying those shareholders the dividends. ROIC then, it is one of my 7 golden dividend metrics. I want to see 10% or more for the majority of companies. For REITs, around 3 to 5%, just to give me faith management are able to effectively allocate their capital. Now ADC, it has been decreasing over the longer term, but over the last 4 years it is still at the minimum that I expect at that 3% level. Operating margin, pretty strong at 48% in the most recent year, although we do note it has started to decrease over the longer term, so something just to keep an eye on and question whether or not management are in fact reducing that operational efficiency. Finally, the net debt to EBITDA, the earnings before interest, tax, depreciation, and amortization. This correlates to 1, the dividend safety, and 2, the balance sheet strength. We want to see below 5.5 here. So what we can see, 2023, 5.55. It is pretty much straddling over the longer period around the maximum we want to see. 2024, nice to note, it is expected to come down for 4.63. So the dividend does look to be safe. The balance sheet does seem to be okay so far based on this information we have. Jumping into the valuation of ADC, and as always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. As always on this channel, we do run through all of these models to get to the intrinsic value. Today's episode, we're going to get straight to the intrinsic calculation. And for today's episode of Agree Realty, it comes to $66. Now, we typically start off with a margin of safety of 10%, which we use if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So margin of safety of 10% is a buy up to $60. At 15%, it isn't too far off, around 50-60 cents shy from the value. So for Agree Realty, we see around a 15% margin of safety. In terms of Wall Street and their expectations, well, they see upside of 19% with a price target of $68 over the 12-month period. As always, do let us know your thoughts in the comments below as we go along these REITs. The next REIT to buy, in our opinion, is NNN REIT. Now, over the last year, it is down 13%. Over the last 10 years, up 17%. And we can see it did peak around $58 pre-pandemic. It's trading in the midpoint of the 52-week range with a yield of 5.6% and a PFFO forward-looking of 12.35. Dividend looks to be safe, a score of 80, market cap 7.4 billion. It is a mid-cap company. Now, when we take a look at those recessionary metrics, well, they increased the dividend during the last recession, positive growth plus 4.3%, and also outperformed the S&P negative 44% versus the negative 55. Not a great dividend grower in all honesty, 2.7% in July 2023, 3% over the last 5 years, 3% over the last 20 years. So this is one area I would like to see them increase starting from 2024. And we can see they are a dividend aristocrat. They have been increasing those dividends for the last 25 years or more. So a quick look at undervaluation, dividend yield theory. We can see undervalued on the dividend yield aspect, 5.54 versus 4.84. Forward P to FFO 12.3, below that 5-year average of 14.5. So another double undervaluation signal. And we can see it is below that 13.7 real estate sector P to AFFO. In terms of the payout ratio, not only is it very low, 68% for a REIT, but it has also been decreasing over the last 10 years. So we would expect to see larger increases moving forwards, at least around that 4% minimum inflationary target. Adjusted AFFO, other than that pandemic where it did drop, it has been continually increasing year on year. 2024 again expected to go higher. And when we look at it percentage wise, we see around 2% expected in 2024 and 2% in 2023. In terms of sales growth, pretty much around that level that we look for, 5 to 10% year on year, other than that expected 2020 negative 1% drop. Shares outstanding, now one thing you'll note, they don't dilute your position as quickly as Agree Realty, although you still see those shares outstanding increase year on year. And now's a good time just to let you know our latest article has just dropped today around share buybacks, running through companies that aggressively buy back shares. If you want to gain access to any of these articles completely free, click on that pinned comment below. We also discuss our 7 golden dividend metrics to find undervalued companies. So moving on then to talk about the essential ROIC. Very strong, around 5 to 6% continuously year on year. 2023 at 6% is nice to note. It is at the upper end, if not above our 3 to 5% minimum. Operating margin very strong in the 60s consistently year on year, and in fact around 62% for the last 3 years. So that is very strong. Management are operating this company very efficiently. Net debt to EBITDA, unfortunately, this is the opposite of what we want to see. It has been increasing over the last 10 years. 5.77 is above the 5.5 we want to see in 2023, but we can see in 2024 it is expected to come down to 5.49. And as we saw on the payout ratio above, it is fairly low, so it does look to be like there is some very nice room for growth on that dividend. So let's jump into the valuation of the NNN, and what we can see in today's episode is that the intrinsic value is arriving at $53. Now, in terms of the margin of safety, again, we start off with 10% until we get near the current trading price, and we can see at around 25%, it isn't too far off, but not quite there yet. So we see around 20 to 25% margin of safety for this particular REIT. In terms of Wall Street and their expectations, well, they see upside of 12% with a price target of $45.50 over the next 12 months. Also, just to let you know, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment below. We then move on to the first REIT to sell, which is MPW Medical Properties Trust. This is down 71% over the last year, and over the last 10 years down 70%, and we can see its all-time highs at around $24 in 2020. It's pretty much at its 52-week low with a yield now of 15.5% with a P to FFO forward of 2.52. Dividend safety, very unsafe, score of 20. Market cap, $2.3 billion, a mid-cap company. In terms of those recessionary metrics, well, they cut the dividend. We can see they had above average growth, and they also significantly trailed the S&P with a negative 76% return. Negative 48% dividend cut in 2023 summer. Over the last 5 years and 10 years, however, it has on average increased by 4%. And we can see, no surprises there, 0 years of consecutive increases. Dividend yield theory, now typically this is why we say we never look at any model in isolation. Purely on dividend yield theory, we see a massive severe sign of undervaluation, likewise on the forward P to AFFO, but that is why we always need to look at other information before we conclude. Real estate 13.7, significantly higher than that of MPW. Now, in terms of their adjusted FFO payout, 2022 at 82%, 2023 expected 76%, and 2024 at 61% isn't looking too bad for this medical building REIT. Adjusted funds from operation per share, well, it has increased over the longer term, as we can see, but two things to note. Firstly, it is very inconsistent. There aren't increases year on year. Secondly, 2023 and 2024 are expected to be decreases from both the previous years, so it does look like it isn't increasing and in fact contracting. And we can see that here with the adjusted FFO per share growth, 2023 expected negative 6%, 2024 negative 27%. Now, when we look at the moderate growth of the sales, we can see 5 to 10% has been increasing more than that every single year for the large part, although 2021 only a 1% increase and 2023 a negative 12% increase to the top line is very alarming. So numerically, it has gone from 250 million in 2013 to 1.42 billion expected in 2023. Now, this should come as no surprise. Again, it is a REIT, 153 million shares outstanding to 598. So when we take a look at the ROIC, it did drop to 3% in 2023, but before that it was ranging between 4 to 7%, which is healthy for a real estate investment trust. Operating margin, again, 2013 to 2022, very solid in the mid-60s pretty much every single year, although we do note a significant drop in 2023 to 40%. Now, this is one area why we do believe that MPW is going to face a massive dividend cut for the second year running, because what we're looking for medical building REITs is below 6 in terms of the net debt to EBITDA. In 2023, they're expecting it to be 8.33, 2024, 9.31. This is very, very high, and I would personally be very surprised if we don't see a dividend cut in 2024. So let's take a look at the valuation of this REIT that we do believe is a sell now rather than an undervalued buy. Now, the intrinsic value here is coming to $6.86. which when we run it through the margin of safety, we can see at around 50%, it isn't quite there yet, at 45%, at least up to $3.77. Now, this is quite important as it does depend on your margin of safety in terms of the risk-reward ratio. With MPW, it is one we have gone through in detail many times, so do check out those videos if you want to see a lot more detail behind these numbers. But you have to understand whether or not you are willing to take the risk with this company. And again, we don't want to get into too much of the details as we've explained it in a more of a deep dive. But at 45%, we see it as a buy up to $3.77. In terms of Wall Street and their forecast, they believe upside of 37% with a price target of $4.86. The second REIT that we do believe is a sell now is Welltower Incorporated. Now, this is up 19% over the last year. Over the last 10 years, up 65%, and we can see it at their 52-week high with a yield of 2.6% and a P to FFO of 23.43. Dividend safety, a score of 70, it looks to be safe. Market cap 53 billion, a large cap company. And when we take a look at those recessionary metrics, well, they maintained the dividend during the last recession, above average growth, and also outperformed the S&P. Dividend growth, well, they haven't increased it since 2020. In fact, a negative 7% on average over the last 5 years. And over the last 20 years at 0%, meaning inflation every single year for the last 20 years has been eating away at that dividend. And we can see there are 0 years of consecutive increases. Given the last few years, as we can see here, the dividend has remained flat. So dividend yield theory, we have our first sign here of overvaluation with the yield below the 5-year average. Likewise, the forward P to FFO above the 5-year average here. And we note it is significantly higher than the real estate sector P to FFO of 13.7. So in terms of the adjusted funds from operation, 78% in 2023, 70% in 2024, no worries there or red flags to highlight. Adjusted funds from operation per share, very inconsistent, and in fact it is moving the wrong way. It has decreased from 366 in 2014 to 311 in 2023. The only positive to note is it is expected to go higher in 2024 to 351. And when we look at this percentage-wise, 5 of the last 10 years, it has had negative funds from operation per share growth. In terms of sales growth, very, very inconsistent. We see some years negative growth, some years pretty flat, and some years below the 5 to 10% we want to target. In better news, the last 2 years have been a lot more positive. Numerically then, we do see it nearly double from 3.3 billion in 2014 to 6.64 billion. They've also diluted your position, although if we do compare it to the companies that we have reviewed, such as Realty, it is at a much slower rate, going from 308 to 519. ROIC then, quite disappointing. The last few years, in fact, we see 2% in 2022, 3% in 2023. Again, we mentioned earlier, it's okay. It is really the minimum that we want to see, but ideally we'd want it back at the levels seen earlier in the last 10 years at that 4 to 5% level. Operating margin, a bit of a huge worry. In fact, it's gone from 26% down to 17% and decreasing over the longer term. This is a red flag indicator. You don't want that operating margin to be squeezed. And then ultimately, not only will they have a net loss, but it'll mean that any value will not be returned to the shareholder as there'll be nothing left to give. Net debt to EBITDA, 5.61 in 2023. So for a diversified healthcare REIT, we do look at 6 as a maximum. It is better to note that 4.87 is expected in 2024. So for Welltower, let's get to the valuation, the intrinsic value. And don't forget, if you have enjoyed today's REIT video, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the current price at $93, well, our intrinsic value is coming to $38. In fact, we see this trading much higher than its intrinsic value, $38 versus $93. So we see there is zero margin of safety. In fact, this is trading significantly higher. Wall Street, ultimately, they forecast around 3% upside. They fight price target of $96 over the next 12 months. As always, let us know your thoughts in the comments below. Are you adding any of these REITs? Do you agree that these two REITs are very strong buys? Agree Realty, NNN, and that companies like MPW and Welltower should be ones that shouldn't be included in the portfolio? As always, let us know your thoughts in the comments below. Smash that like button if you enjoyed it. Subscribe, join this community, and as always, I'll see you all on the next one.